A buzzword in the news these days, the 50-year mortgage. Do you want one? Should you get one? Do you need one? To start off, I need to make a point here. Mortgage lenders view a shorter term mortgage to be less risky because over the course of time, conditions can change, market conditions can change. The interest rate is volatile and it could go way up or way down. And the terms of whatever they agreed to on the day that they signed that mortgage have to be fixed terms for the duration. So a short-term mortgage, a 10-year mortgage, is a lot less risky to a lender than a 50-year mortgage. And because the risk is different, the charge is different, the fee is different, the interest rate is different. So a shorter term mortgage, a 15-year mortgage, for example, is going to have a little lower interest rate than a 30-year mortgage, which is going to have, in turn, a little lower interest rate than a 50-year mortgage. The 50-year mortgage right now is probably the most volatile, the biggest risk that a lender could take on because they are taking on the risk that over the course of 50 years, the market is going to remain consistent and stable enough that they are not going to be losing money in the long term. They're also taking a risk on your property, on your neighborhood, that the conditions don't change in your neighborhood over the course of 50 years such that it would impact the value of the lien that they have, the asset that they have their mortgage on. Next, one of the big, it's not a misconception, it's a way that we use language that isn't exactly correct. You hear a lot that lenders take their money first. We hear that from buyers and sellers all the time. The lenders are going to take their money first. You're going to pay the interest first. You pay interest on the balance of your mortgage. And the balance of your mortgage is highest when your mortgage is brand new. When you first take it out, the balance is really high. So you're paying your interest rate, 6% or whatever the interest rate may be, on the full balance. And of course, as you pay it off, the balance is less, and therefore the interest you pay is less. It's front-loaded because the funds are front-loaded, right? The balance is the biggest at the beginning and the smallest at the end. So you pay interest more at the beginning and you pay less interest at the end because it is literally interest on the balance of what remains on your mortgage. If you have a 30-year, $200,000 mortgage, doesn't matter what the price of the house is, right? That's it. You could have a $210,000 house or you could have a $500,000 house. But the balance of what you owe the bank is $200,000. And you're going to pay 6% interest, let's say, on that balance of $200,000. Your payment and interest for that $200,000 mortgage for 30 years at 6% is going to be $1,199. You're going to have taxes, you're going to have property insurance, all of that kind of stuff. But the payment and the interest is what we're talking about today. $1,199. So month one, you have a balance of $200,000 and your payment is $1,199. Well, that first month, $1,000 of your $1,199 payment is going to be interest. That's $1,000 of interest that you owe because you owe 6% on a balance of $200,000. So $1,000 goes to interest, and therefore you're left with $199 that's going to go to your principal. So you have a new mortgage balance of $199,801 because you've paid off $199 of that. So now you're going to, again, pay 6% on that new balance. That's going to be $999 of your $1,199 payment. Remember, your payment doesn't change. That $1,199 stays the same for all 30 years. So now $999 of that is going to interest, and the rest of it goes to principal, and so on and so on and so on. And you can see that the interest number incrementally gets smaller and smaller and smaller because your balance gets smaller and smaller and smaller that you're paying against. So after 10 years of this, let's say the average person probably lives in their home about 10 years, that $200,000 mortgage that you had is now only a mortgage of $167,000. And you, in turn, have an additional $33,000 in equity that you didn't have when you started making payments 10 years ago. That $33,000 is money that is now yours. It is in the value of your property. Your property has probably appreciated over those 10 years as well. And you have built a bigger nest egg that you can then turn around and take into a larger property, an investment property, whatever that might look like. That is your money that you have earned off of that property. Let's flip it on its head here and look at what does that look like for a 50-year mortgage, the same loan. You have a $200,000 loan. Now remember, your lender is going to charge slightly more for a 50-year mortgage because they are taking on the risk of that 50-year term. Let's say that instead of 6%, your lender is going to charge you 6.5%. And what that gives you as the consumer is it gives you a slightly lower monthly payment than what you would have been paying with a 30-year mortgage. So that is where you, the consumer, are seeing the savings. Instead of that 1199, now you're at 1127. So your monthly payment is less. That's going to help you meet the bills from month to month, right? That's an electric bill that you're paying now that maybe you weren't able to pay when you had that 30-year term. But herein lies the issue. You are now paying a higher interest rate. You're paying 6.5%, and you have less money from which to pay that 6.5%. So now your 1127 payment, when you pay your first mortgage payment, 1,083 of that is going to go to your interest. And the balance that's left over is like $45. $45 toward your principal of $200,000. And now you have a mortgage of $199,955. You've paid a teeny tiny bit. And once again, the following month, 6.5% out of that. Your payment isn't as big, so there aren't as many dollars left over after you pay your interest to apply to your principal. And after 10 years of the exact same mortgage, you have only paid that mortgage down to $193,000. That's a massive, massive difference in the equity that you have accrued over those 10 years of living in the same house with the exact same appreciating value, the exact same mortgage that you started out with. Instead of walking away with $33,000 of equity in that house, you now only have $7,000 of equity in that house, and it's going to be a lot more restrictive to try and take that $7,000 and turn it around into another property, a bigger house, an investment, whatever that might look like. You just don't have as much to play with. And by the way, guys, when we talk about the amount of interest paid over time, that 50-year mortgage for the exact same house is going to cost you $240,000 more than if you had just had a 30-year mortgage. The difference that you're saving, the $70 a month that you're saving on that monthly payment amounts to $240,000 more that you have paid for the exact same house. And I'm not suggesting, we all need mortgages, every single one of us. We all are paying more in the end for that house because we are paying for the opportunity to have the payments spread over time. I completely understand that, but wow, that's a doozy to swallow. You've bought a whole extra house in the amount of time that you have taken to pay off this 50-year mortgage. Frankly, I got into this business because I am inspired by helping people build wealth. By and large, the average individual's number one asset that they own in their life is their home. And that home is what allows you to ultimately, for most people, to be able to retire because you have made payments into an investment and that house is holding its value for you so that when it comes time to retire, you have something that you have saved. You are able to maybe downsize, move into an assisted living or something like that, and you have this nest egg that you have saved up over time. That is building wealth for your family. And for a lot of people, it is taking the wealth you build from the first house to buy the second house, and taking the wealth that you build from the second house to buy the third house, and building wealth over time through property is what I am personally very, very passionate about, and passionate about helping people do that. It changes the trajectory of your life and your family. So I am absolutely all for any of the ways that you could possibly pay less interest and grow more wealth for yourself. But there are absolutely reasons why a 50-year mortgage might be the best option for you. If you are somebody who really needs liquidity over equity, you're not trying to build equity for the long term, you're not trying to establish an asset, you're not trying to grow your wealth, you are trying to keep cash in your pocket because liquid cash is what is important to you. This might be a business owner, for example. If liquid cash is what is the number one priority, then perhaps a 50-year mortgage would work better for you. If you are in an extreme affordability crunch from month to month, The monthly payment on a 50-year mortgage can be less, and it can relieve some of the pressure of the month-to-month affordability for you. However, if that is you, I would have an exit plan before you get in. I would make a plan for yourself that you are going to do this for so many years and then be able to refinance into something that has better terms so that you can get out of that cycle of simply paying interest for 25 years. If you want to know what some better options are, again, I strongly suggest that you reach out and speak with a lender near you. And if you need a recommendation, please reach out to us. But look at a temporary rate buy down. A temporary rate buy down can impact what you are paying month to month for the first couple of years of your mortgage and give you a chance to start earning more at work, to change jobs, to remove some of the other debt from your life so that you can contribute more to your mortgage payment. And that temporary rate buy down is fairly inexpensive, and sometimes we can get the seller to pay for that too. So it's not money out of your pocket, it's just a savings for you from month to month. Maybe an adjustable rate mortgage is for you. I would have a caveat here. I would explore the terms, but sometimes an adjustable rate mortgage can be less expensive in the early years and therefore provide you an opportunity, again, to make lower payments at the beginning before you have to take on the bulk of your payment, and give you an opportunity, if you think you're growing in your business, if you think you've got debts that you can pay off and then have more cash to contribute to your mortgage, adjustable rate might be an option for you. And of course, what I always come back to, and you've probably heard me say this in other videos, buy less house. Instead of a $200,000 mortgage, work with what you've got. Take a $160,000 mortgage with a payment that does feel comfortable to you. Live there and allow it to accrue its equity and then buy up. We can't all start in our dream home, and we all need to start somewhere. Adding to that equity, building that equity somewhere is going to help you be able to get to the next house where it feels a lot more like what you've always wanted. Just buy something clean, buy something safe, and allow it to start building money for you. This is a huge topic, and there's a lot to take in here. And again, I have said it before, but I recommend that you speak with a mortgage lender if you have questions about this. To be connected with a mortgage lender here in the greater Louisville, Southern Indiana area, please reach out to us at symphonyrealtygroup@gmail.com.